Okay, good morning, everybody. Thank you for joining the call once again. Mortgage Mondays with myself, John Mooney, and with my co-host, Aaron Wise. Happy Earth Day to everyone. Beautiful day. The sun is shining. It's going to be 65 degrees. And as we know, good weather, happy lenders, happy real estate agents sell more homes. It's a proven fact. So thank you for joining us here today. As more continue to join us, I will be muting those as they join. So without any further ado, I will kick it over to Aaron Wise. Aaron, any opening remarks from you this morning?
Yeah, good morning, everybody. Thanks for popping on here. Multiple offer. Maybe we'll talk about some more multiple offers after that. I think right now, we have a nice packed agenda here, but I think we want to touch pretty heavily on just getting your buyer in the right headspace for what's going on out there right now. We're just seeing a huge gap with our pro agents versus people who are just dipping their toes in right now. So we'll touch on that here in a little bit, but it was a busy weekend, but I think there's a lot of disappointed buyers out there, and there's a few happy ones. Luckily, I think we're happy to be on the right side of that, but what we want to do is try to help give you a couple bullets to try to help you win some of those. So John, you seeing the same?
Absolutely.
Yeah.
Yeah, so we'll get into the details on that here. Just to kick it off here. So thanks again, everyone, for joining us. Our next session will be on May 13th. As you know, we do this on the second and the fourth Monday of the month. Last session was canceled. I did hear from a couple of you folks that for whatever reason you didn't receive the cancellation, so apologies if you did not receive it. But we were off last Monday and we are back on our schedule second and fourth Mondays today going forward. So the next call is the 13th of May. We try to move and groove to get through these within about 20 minutes or so. The idea is that, if you guys are in between appointments at a coffee shop, whatever the case may be, you can jump on this call, listen, participate. We want your lender scenarios. We want to hear about the issues that you may be having with other lenders. Even if we don't get the business, we will help coach you through that. And we'll, talk a little bit today on multiple offers and what's going on with the market. So, as you know, we send out a recap of these calls with any links that we reference to you guys to get the actual articles in hand. So first one we'll talk about today is the case for a transaction turnaround. Okay, I'll read off the very beginning of it here, but spring housing market is off to a sluggish start, with home sales falling in March as compared to February. Economists say a resurgence in mortgage rates and inflation could be softening the sales at the start of what is traditionally real estate's busiest season. Despite the headwinds, sellers continue to see home prices grow and buyers' appetite for housing remains high, and bidding wars are still occurring. On top of that, a growing job market may offer some rosier prospects for home sales. But existing home sales dropped 4.3% in March as compared to the prior month and are nearly about 4% lower than a year ago. That just comes to number of transactions, okay? While more listings came on the market last month, the increased competition among sellers did not appear to hurt home prices. The median existing home sales price increased almost 5%. Reaching about $393,000, the highest price ever that was recorded in March. Okay, so there are things happening. Okay, so to Aaron's point, multiple bids are out there in many cases, especially in the single family market. We have ways to help guide you through that. And before I kick it over to Aaron to comment on this, the last thing I wanted to mention is our division of guaranteed rate, the affinity side, okay, we actually closed, about 25% of our loan officers closed more volume in quarter 1 of 24 than quarter 1 of 23. Okay, and the reason we're seeing that is, we're seeing a flight to quality out there when it comes to who buyers are selecting as their agents, as well as, who they're selecting as their lender. So Aaron, I'll kick it over to you for the next comment.
Yeah, I like that comment right there. I feel like people aren't choosing who they want to go with due to their family relation anymore. They're not using their uncle who, helps close a purchase or two per year, that type of thing. I feel like part of I try to be glass half full sometimes here. And as we've been working our way through this NAR settlement business, I feel like what it's done is it's started to widen the gap here more and more, where your part-timers, your people that are not putting in the work, they're just fizzling out. I can just tell you there's a lot of people who I haven't heard from in a long time, which is interesting. And the people who are winning these offers weekend over weekend are usually the same pretty select group. So I feel like just that gap is widening as we continue to progress, and I don't think that's going away. I think it's just going to continue to get deeper and deeper. So for me, it's just all about trying to communicate value, communicate expectations, and kind of getting your gun, getting your helmet, and getting in there. And I think the other thing too is if some people are not interested in doing that, I think that's okay. Especially when you're talking about buyers who are, dipping their toes in and trying to see, if they really want to make a move, and, maybe they need to kind of get beat up a little bit before they decide to really, get serious. Somebody who's on this call right now, one of our buyers, I think they maybe lost, I don't know, 4-5 contracts before they finally won one on Friday. And it took a village to get it done. It took the earth, moon, sun, stars, the whole shebang. But I think it was a gradual process that they had to go through a little bit, which was, what's the definition of going in strong, right? What does that even mean? I think we have to kind of recalibrate our buyers' minds a little bit, where prior to 2020, going in and giving somebody list price was considered a pretty strong offer. And what's crazy is now that's just really a starting point. That's really all that it is. A lot of people that are on the call right now have heard me say this over the last few weeks, but it feels like if you want to be in a competitive space, you've got to be in a 10 to 15% over list price range. And that's pretty bananas. And I know that's a pretty big generalization to make. But good example, if you're in a $600,000 space and you're not at 650, 660, I don't know if you're really in a competitive space. As we know, it comes down to a lot of other things, but I used to be able to, if you had 3 or 4 out of those 8 levers, you were in pretty good space. Now I feel like it takes maybe 6 or 7 of those levers in order to win. And we're talking about, your as is flexible closing date. If you go in with kind of a goofy lender, you're just not going to win. So, we can talk about this for the whole call if we wanted to, but that's a really interesting just kind of note to have. 10% is your number. Unless you get lucky and you're the only game in town. I think that's where you got to be to give yourself some elbows and beat some people up that are your competition. So.
Yeah, so let's talk about some action items here, right? So I think the message to buyers is to get involved and educate yourself early. Okay, so one of the things that we have that helps with that is our initial pre-approval is done on a soft pull on the credit report. Okay, so there's no reason not to have this conversation early, so we have real numbers and know what they can expect from a financing standpoint, okay? You know, once they're out looking at houses and once they decide to make an offer, right, things move really fast, okay? And you know, your client may have to make a $750,000 decision in the matter of a couple hours, right? At that point, they don't want to be chasing their mortgage lender down for an updated pre-approval. They don't want to be running scenarios on this price versus that price, this amount of down payment. All that stuff should be front loaded, okay?
Yep.
Now, if it's not set up that way, we can move quickly. We do turn around updated pre-approval letters same day on the weekends. We do it within an hour or two during the week. Okay. But the key is to get involved early and be prepared to act when you've got that decision time in front of you. Okay. A couple other things, just to kind of hit on here. You know, we talk about our power bid pre-approval. That is a fully underwritten, takes the pre off that pre-approval letter. Okay. So in the situation where it's competitive bids, or if they're competing with cash, this allows them to waive finance contingencies, knowing they've already been through underwriting, and we can close it in as little as 7 days, 10 days. Okay. Saw a couple questions come into the chat here. So, you know, how does it work if the appraisal doesn't appraise for 10, 15% over list, right? First of all, we should talk about what list price means. It doesn't mean a whole lot, okay? Last couple of years since the pandemic, we've seen some listings are artificially low on list price. Why would they do that? Because that agent probably knows they're going to have 10 offers and they're able to get escalation clauses and it's going to go over list price, okay? So an appraiser is not going to say, well, it was listed for this, so that means it's only worth that, okay? So you're not going to have that problem. The other thing is, you know, I feel like there's a misconception out there where if I'm using round numbers, but if they're buying at 500 and you appraise at 480, I think the general buyer or general consumer thinks you have to bring 20 grand to the closing table, which you do not, okay? If you are planning on only putting 5% down, then you will have to bring some more money to closing. Okay. However, you know, most buyers are not putting the 5% down. So there's some wiggle room there. Okay. So if they're starting at 20% down payment, appraisal comes in 20K low, well, they're able to adjust that loan amount if needed. They may not have to bring any additional money to the table. Okay. But it's going to depend on how much down payment they were planning initially. If they bring some, all, or somewhere in between as far as that shortage goes. Okay. In addition to that, Aaron, myself, those of us that work in my group, we have a process as to how we can rebut a low appraisal. Okay. So we have an opportunity to go back to the appraiser to say, what about this comp? What about that comp? What about these, you know, features that this property has that aren't in these comparables? So we have an opportunity to appeal the appraisal. If we don't get the value that we want on appeal, if we can show the appraisal's flawed in some way, we can get a second appraiser out there. Okay. So there's a lot of angles and a lot of things that can happen should we face a low appraisal, and very seldom does it turn into the customer bringing every dollar of that to the table. Okay. So, by all means, if you guys want further dialogue on it, we're happy to have it. Reach out to us. We may be able to do a specific call just on the appraisal process and rebuttals at some point. Okay. We want all of this content to be valuable to you. So if there's anything you guys want to focus on, we're happy to focus on it on future calls. Okay. A couple other things as it pertains to education and new clients. So, throwing into the chat here, of the purchases happening, how many are investment property purchases? Anyone have a guess?
This number was actually surprising when you sent that to me this morning.
Yeah, so,
Repeat the question, please.
yeah, of course.
Oh, sorry, repeat the question, please.
Oh, repeat the question, of course. What percentage of transactions are investment property purchases? So of all the purchases, how many are investors? %25's a guess, 50%'s a guess. The actual number is 29%. Okay, so 29% of purchases right now are investment property purchases. I was surprised by that. I thought it was a tick or two lower. Okay. One of the things that we can help with is we have DSCR loans, which stands for Debt Service Coverage Ratio. Okay. Fannie and Freddie has made it more difficult for those investors to get mortgages on their purchases. Okay. So DSCR is an alternative. It's one of the easiest loans that we have to close. We're really getting title, we're getting an appraisal, and we're looking at the cap rate on that property. Cap rate meaning rental income as proposed to mortgage payment. We're not proving tax returns, W-2s, qualification for these buyers. These are actually, purely underwritten off the property itself. Okay, so as these investors become more prevalent in the market, you've got some options to get them financing, whether it's at the closing table or after the closing, if they're purchasing in cash. Okay. Question came in, are DSCRs a higher interest rate? They can be, but not in all cases. Okay. Don't forget, one of the things Fannie and Freddie has done is basically require points, multiple points, 2-3% in discount points. Okay. In order to get a conventional investment property done. So while, let's say the rate may be 7.5 on an investment property purchase, the closing cost is going to be 2 or 3% higher to get that 7.5. Okay. DSCR, you might be in the high 7s or possibly the low 8s on that rate, but you're not going to have to pay 2-3% additional closing costs in order to get it. Okay. So any scenarios, by all means, reach out to Aaron, reach out to myself. We're happy to answer them. Just going back to the chat here, there was a question. So, how have your appraisals been coming in with these crazy offers? I noticed these last few weeks that the appraisers are starting with how many offers did you have and what were they? Okay, so look, it's competitive out there, right? And from an appraiser's perspective, the worst thing that could happen is they are perceived to be inflating value. Okay. Thankfully, we're not seeing a whole lot of short appraisals. Not to say it never happens, because it can and it does. But we're not seeing a lot of it. We're seeing more the last year and a half than we've seen in a long time. Okay. But having said that, we're not seeing it very common. And even if we are, we've got some angles to work. So again, happy to discuss more on future calls on that kind of stuff, but wanted to speak to that question since I saw it in the chat there. Aaron, anything you want to add before we move on to final items here?
Just to double down on that question, appraisers aren't going to give value because there's multiple offers on things. I do feel like though subconsciously that's why they're asking. I guess I think about it this way, our purchase that we're doing. Okay, so let's say, Kristen asked the question, let's say we have a buyer. Usually we're not the ones that are setting the market within the city of Chicago, like our one deal. It's kind of crazy everywhere, right? And so if it's crazy everywhere and you know, prices are super high everywhere, what they're going to do is they don't, you know, they're looking at the list price, yes, but in the end, it doesn't matter. They're looking to see if, and asking if it was multiple offers, and you know, if the listing agent is presenting all those offers with the names scribbled out and all that, you know, the highest comp is the highest comp is the highest comp, right? You just, it's tough to be the most expensive, you know, place on the block. But so far, most of what we're doing and what I'm seeing is we're right in line with everything else that's a little wonky, right? So if we've got a 2-bed, 2-bath going for, you know, middle fives, which, you know, historically is bananas. We're not the only ones that are, you know, at a 2.2 in the mid fives. There's going to be other ones that are out there. And so normally, you know, those are the ones that we're grabbing onto for comparables, right? So just to clear up that appraisal piece, I do think it, though subconsciously it does matter. You know, if an appraiser walks in there and they see, you know, 10 different contracts sitting there, again, this is just my 2 cents. You know, they're not going to go above that higher comp that was, you know, super close and whatever. But I do think there is something there where they're like, hey, the market's crazy. You know, there's going to be another 2-bed, 2-bath that's out there that we could use for that comparable. As far as let's see, Jane, you had something in the chat. I think it's a little tricky quoting rates on investment properties, but what I will say is right now, you know, if a normal primary residence is, let's call it low to mid 7s, I think you're going to see an investment property in the high 7s with a 1.5, depending on if you're doing the minimum down. So investment properties, your minimum down is normally 20%. Those are going to have a 1.5, 2 points attached to them normally. Once you can commit to a 25% down, it's going to take the pain away a little bit on that. It's kind of a scenario where when you do the minimum down, you're going to pay for it a little bit, right? So anytime you do the minimum, it's going to be more expensive. So if you're going in, you know, non-owner occupied and in the investment space, 25% is going to be your kind of sweet spot. And I will say, not to continue this on even further, but for all of us that are working with buyers right now, you know, 20% is almost kind of thought of as like, you're going to get the best deal in town. I would say prior to 2020, that was the case. There is a nice incentive right now for buyers to do 25% down. We're seeing that across the board, condo, single family home, doesn't matter. It seems like interest rates are pretty in line with, you know, if you're doing 10% down or 20% down, it's roughly about the same. But I'm almost noticing about a 1/4 point decrease on an interest rate when you're going from 20 to 25% down. Again, it's easy for me to sit in a chair and, you know, say, hey, just do an extra 5%. That's no problem. But for your buyers that have that, you know, cash sitting around, we're always bringing that up. Our goal is to, you know, not do the highest loan possible, although that's lovely. Our goal is to get them the best deal possible. And so we're always bringing that up. Is just a nice little sweet spot. So I just wanted to touch on that real quick.
Awesome. Thank you. So we'll start wrapping up in just a few minutes here. A couple things just to touch on. This will be in the recap that we send out. Nearly 40% of renters think they'll never buy a home. 40% of renters. Last year, that figure was 27%. Okay, so I think the message that we all need to get out there is it is a great time to buy a home. It is, right? And I think anyone that tells you it isn't already owns something and is glad they're not buying in today's market. Okay, it's not an easy time to buy a home. Let's differentiate that. Okay, it's not easy. It's probably harder than it's been in a while. But compared to what the market's going to do in 25, 26, 27, those folks are going to be thrilled that they purchased in 2024. Okay. And, you know, it calls to action education, right? For the last, I don't know, 2009 till maybe 2020, 22, in many scenarios, you could buy that home for as a similar monthly payment than what you could rent it for. That's probably no longer the case, okay? But we know there's a gazillion advantages to buying versus renting, okay? So those rent versus own comparisons, those cost of waiting comparisons that Aaron and I can do for your clients, those are going to be more valuable when you're comparing, I could rent this for this much, or I could buy this for this much housing payment. What makes sense over the long term? Okay. In our recap, there's a couple other things in there that I'm not going to drill down on now just due to time. But there's a link about 7 myths that are being debunked due to the NAR settlement. So that will be in the recap. And then there's a seller survey from realtor.com in there as well. 85% of sellers' surveys have been thinking about selling for the last 1 to 3 years. And interestingly, 79% of sellers' surveys wished they listed their home earlier. Okay, so again, get in front of them. It's never too early to ask for those conversations. Last but not least, we did a reverse mortgage seminar. So in the effort of increasing inventory, increasing the number of transactions, and giving more homes on the market, those retirees with a free and clear home can sell their home and purchase the new home using a reverse mortgage. Okay. Our recap will be linked into the summary that we send out after the call. So just wanted to call attention to that. If you've not watched it, there is really good information in there. Aaron, want to go ahead and bring us home here? We're just about at the top of the hour.
Yeah, just in summary, guys, I mean, it feels like right now, I always kind of imagine us trying to move the goalpost closer and closer for a buyer to go from beginning to end, right? And, you know, before, I would say prior to this market that we've been in for a couple of years, we'll call it, you know, the movement was normally caused by education up front, just having those conversations. And then, you know, we find a property or two and start moving on it. I feel like right now, part of the educational process almost seems like it's going in on something and failing, and going in on something new and not getting it, and then kind of getting it maybe that third round, that second or third round. So to me, I just think that process has changed where we have to be able to tell our buyers and kind of keep them on the horse a little bit. What I've started doing is when my buyers lose an offer, which, you know, is still happening here and there, I'm trying to really reach out to them and make sure that they're not just completely devastated. Sending them a note in the mail, you know, just say, hey, listen, don't worry about it. Get back on the horse. This is part of the process, et cetera, et cetera. So I feel like in the beginning, we've got to be a little bit more transparent, not a, hey, we expect to lose transparency, but almost this is part of the process sometimes. And so we're going to kind of learn through pain a little bit, what's aggressive, what's not aggressive. And then you sort of got to move your barometer a little bit about, you know, what you're comfortable with. So I just think that education right now is, you know, 70% of the deal. It's what to expect. How are we going to go in on this thing? So that way, when you get in the heat of the moment, you know, and it's, you know, 4th down and you're on the 1 yard line, you know exactly what you need to do. And you're not having those tough conversations at that point. You've already gone through all that stuff. And if it's not the right property, then it's not, you know, and that's okay. And what I'm finding is usually when people don't want to go in super, super strong, it's not the right one for whatever reason. But when it is the right one, then that's when it's time to recalibrate, get all the guns blazing. I don't know what's with all these analogies here this morning. Sorry about that, but we get the idea. We got to go in strong. So that's what I got.
Yes, sir. And help, allow Aaron or myself to help you win those multiple offer situations. Who the lender is matters more on those multiple offers, than, than even they do traditionally. And traditionally, it's always been a big deal, right? So, thank you once again for joining the call.
Oh, one last thing, I'm sorry. Do you
Yeah.
guys know when the next time the interest rate may go down? Is that later this month or in June?
Well, so right now, the Fed's meetings in June and July, the market's only pricing in about a 20% chance that they're going to cut rates. Okay.
Okay.
I feel like they're waiting to see unemployment claims, and when unemployment claims go up, that's going to increase the likelihood the Fed's going to cut rates. Okay.
Okay.
Now,
Very good.
having said that, rates can go down without the Fed cutting. Okay, so if the Fed announces they're going to slow or stop selling the mortgage-backed security treasuries, that can lower rates. But after, say, July, we're into the heat of the election, right? So August, September, the Fed is not supposed to get political, and it could be perceived it being political if they're cutting rates before the election. So the forecast is, maybe 2 cuts at most between now and the end of the year. And that's what we're reading the tea leaves with the Fed to try to signal when they're going to start cutting.
Makes sense. Makes sense. Thank you.
You bet. Okay, everybody, once again, thank you for joining the call. We will see you back on the 13th, 10:30 a.m. for Mortgage Mondays. Have a great week. Let us know if you need anything. Have a great one. Thanks for joining us.
Have a
Thank
great week,
you.
everybody.